Hey everybody, Matt from 90th percentile.ca here. For access to more study notes, practice questions, mock exams, and end of chapter question videos, visit 90th percentile.ca and sign up for your free trial today. Link below in the description. Now we make our way to equity market indices. Key two topics here. One, we're going to be talking about different weighting methods and return calcs associated with market indexes. So there's a bunch of different ways that these index creators can weight the securities or place a greater or less emphasis on certain securities in an index. Four main methods are up here, so they can either be equal weighted across all stocks, market cap weighted, price weighted, or weighted based on fundamentals. So the fundamentals would be related to some metric that the index creator decides. Um, but either way, these are all options and represent the weighting methods. So we'll go over those and actually calculate some index values and returns based on the weighting methods up here. And then speaking of return, we're also going to be able to, by the end of this, calculate a price return versus a total return for an index, with the only real difference here that a total return includes price changes from here, but also includes interest and dividends received. From there, we're also going to briefly touch on some other indexes. So indexes that are used to track commodity prices, fixed income strategies or prices, and hedge fund returns. These are, more of a second thought in this module, but nonetheless, I think it's helpful to understand how they're constructed and some of the implications for these indexes that are different than for equity indexes. So with that, let's jump into the questions. 1 month after inception, the price return version and the total return version of a single index consisting of identical securities and weights will be equal if A, market prices have not changed. Um, kind of, not really. B, capital gains are offset by capital losses. No. Like when they're asking about here price return version and total return version, the key difference here is that the price version of an index is only concerned with the, not percentage, but just change in the security's price. And the total return has to deal with the change in price as well as any income or dividends received. So here, C is the correct answer. It's more correct than answer A, but that's why I was kind of hesitant. So the price return version and total return version will be the same if there's no dividends or interest. If market prices didn't change and there were no dividends and interest, then sure, this would be correct as well, but there's just not enough information. It's kind of weird, worded poorly, in my opinion. An analyst gathers the following information for a price-weighted index comprised of securities A, B, C, D, F, G, H, I. And we have securities down here, the beginning of period price, end of period price, and dividends. And we're asked the price return of the index. So automatically scratch out dividends because this would be for a total return. So what we got to do basically here, the price index value is going to be the sum of all of these prices in each period, right? So it's a little bit different versus like a maybe like a market cap weighted index or something like that, where you would weight the value of the index based on each company's market cap. So like our companies with higher market caps would represent a greater proportion of the index. But here is just price weighted, so we can just sum up everything. So here, yeah, so sorry, so end of period is going to be the 27 plus the 25 plus the 16, and we get an end of period value of 68. And then the beginning of period is the 25 plus the 35 plus the 15, which is what, 75. So we have a negative return, which is going to be 68 over 75 minus 1. And we get an answer of negative 9.33%, which is B. analyst gathers the following information for a market cap weighted index. So this is what I was talking about just a second ago. Comprised of securities, MNO, QRS, XYZ. So we have securities, beginning of period price, end of period price, dividends per share, and shares outstanding. And we're asked for the total return of the index. So here dividends are actually going to be relevant. So a couple steps here. First, we got to weight, each security by its market cap. So that would be its share price times shares outstanding. But we have to do for beginning of period and end of period values, right? So let's do this. So beginning of period, end of period. So the first one for MNO is going to be the 2,500 times the 5,000 shares outstanding. And we're going to get 12.5 mil. Just keep it in millions, keep it clean. And the end of period value is the 2,700 share price times 5,000 shares outstanding, which is 13.5 mil. Moving on to QRS, it's the 3,500 times 7,500, and it's 26.25 mil in the beginning of the period, and then the end of period, the share price tanked. So it's going to be the 2,500 times the 7,500, 18.75 mil. And then XYZ, same kind of concept, right? It's going to be 1,500 times 10,000, 15 mil, and then 1,600, 10,000, 16 mil. Okay, so we have from this we could calculate the price return, but we're asked for total return as well. So we have dividends per share, 100 in this case. So 100 times 5,000 shares outstanding, it's going to be 0.5 mil in dividends. This 150 per share, 7,500 outstanding, 1.125 mil in dividends. And then here, 100 times 10,000 is 1 mil in dividends. 1 mil. Okay. So the last step here is to sum up all of these values. And if we sum up all the BOP values, we get 53.75 mil. Sum of all the EOP, we get 48.25 mil. So we had a loss over the period, but that's going to be partially offset by the dividends received, which were 2.625 mil. So now we can calculate the return the similar way that we did in the last question. So we have basically EOP minus, or divided by BOP minus 1, right? But in this case, it's going to be, the EOP value is going to be this plus the dividends. So 48.25 end of period value plus 2.625 in dividends over 53.75 beginner period value minus 1, and we get a total return of around negative 5.34%. So our answer is B. Which of the following index weighting methods requires an adjustment to the divisor after a stock split? So is it a price weighting index, fundamental weighting index, or market cap weighting index? Really quickly, just in case it wasn't clear, we can go over how these are weighted, like the actual index price that will display on the stock market. For a price weighted index will be the sum of stock prices over number of stocks. So here you can see that a given percentage change in a higher price stock would have a greater impact on the index value, right? And then for B, the fundamental weighting, there's no like defined formula for this really, because in a fundamental weighting, you're weighting the index based on some sort of metric. So it could be like earnings, dividends, cash flow, something like that. So then you would just essentially, take the weighted average of each company's metric and then sum up all of those and come up with the index price. So it's a little bit more ambiguous from a formula perspective. And then the market cap weighting, we kind of went over this, but it would be the current market cap of all stocks over the base year market cap. So this would be like, year 0, year 1, something like that. And then you would multiply it by the base year index value. So which of these already accounts for a stock split? So a stock split, really simply, let's say a company's trading at $100 a share and it has 1,000 shares outstanding. Then it wants to do a 2-for-1 stock split, so it'll be two stocks in the market for every one that exists currently. So they'll have 2,000 shares outstanding, but to keep the value of the company equal, because a stock split doesn't, theoretically shouldn't increase the value of the firm. So then you're gonna have to have the share price be 50 bucks. So if the share price is changing to 50 bucks from 100, then you're gonna see right away that in a price weighted index, you're gonna have to adjust for that, right? Because you're summing up all the stock prices, which was 100, now it's 50. So it's gonna have to be adjusted for here. Whereas in like a fundamental weighting or market cap weighting, um, maybe we start with market cap first. The market cap of this company in this example stock split is still the same, whether it's a $100 share at 1,000 shares outstanding or 2,000 shares at 50 outstanding. It's the same market cap, so it's automatically adjusted. And then for a fundamental weighting, typically you'll be using metrics such as like EPS, earnings per share, or like price per share to earnings or something like that. So when this stock split occurs, once again, these ratios will all automatically reflect the effect of the stock split. There's no additional work that needs to be done. If the price return of an equal weighted index exceeds that of a market cap weighted index comprised of the same securities, the most likely explanation is stock splits, dividend distributions, or outperformance of small market cap stocks. So an equal weighted index, really simply, if you have two stocks, one trades at 50, one trades at 100, then the index price is going to be the average of the two, so 75. Um, but so this is equal weighted, right? But this doesn't account for the market cap of the stock. So like in a market cap weighted, and we had the 50 bucks stock and the 100 bucks stock, we don't know what the index value would be without knowing the market caps of the stocks, right? Because we kind of went over this a couple times. The index value will be weighted based on the market cap. So in this case, the price return of the equal weighted index exceeded the return of this. So we must have had small cap stocks that are, let's just keep it really simple. Let's say there's two stocks. This one here, the 50 is small cap, the 100 is large cap. So in an equal weighted index, if this $50 stock went up to, 100 and this 101 stayed the same, then there's going to be a big return from this index, right? Because like half of the index's value is doubling. Whereas let's say this in the market cap weighted index, this $100 stock was like 90% of the index. It's like 9 times the market cap. Whereas this one was 10%. If this 50 bucks here went up to $100, it's not really going to make that much of a difference on the market cap, um, the price return of the market cap weighted index, right? Because this one is just such a bigger portion of the index, and therefore such a bigger portion of returns are dependent on this stock. So in this case, we must have had some small cap stocks outperform. reconstitution of a security market index reduces A, portfolio turnover, B, the need for rebalancing, or C, the likelihood that the index includes securities that are not representative of the target market. So what is reconstitution? This is basically a process that occurs every so often when the people who are creating these market indexes review the constituents or the actual securities in the index and decide, do a periodic review to decide whether or not they still belong in the index. And the index basically has the objective of tracking, some sort of criteria or characteristics of an underlying market, right? So like the NASDAQ index is a bit more heavily weighted towards tech, right? Whereas like Dow Jones and S&P are more, kind of general market, just the overall market for the most part. Like you wouldn't see McDonald's trade on the Nasdaq, right? Like it's not a tech stock, so it wouldn't be a part of this market. Um, on top of that, these market indexes are also gonna have certain criteria regarding, like size of the companies, all that. Like you're not gonna have a company with a 10 mil market cap trading on the Nasdaq. So in the event that some company loses like 99% of its share value, it's gonna be removed. Kind of stuff like that. Um, so coming back to the question, reconstitution reduces the likelihood that the index includes securities that are not representative of the target market. So it's kind of, what I was referring to here with the McDonald's stuff and with the losing a lot of its share value. It reconstitution will increase portfolio turnover when, well, this is mainly because like if ETFs or an investor's portfolio has a goal of tracking the Nasdaq, I mean you could do it like simply through ETFs, but even ETFs who follow the Nasdaq will have to buy or sell securities based on the weighting of each security in the Nasdaq, as well as what stocks are actually in the Nasdaq, right? So kind of cross both of these off with that explanation, but we're gonna reconstitution increase the need for rebalancing and increases portfolio turnover. Which of the following statements regarding fixed income indexes is most accurate? A, liquidity issues make it difficult for investors to easily replicate fixed income indexes. Yeah, this is actually the answer. Generally, I mean, even just reading this question, you're probably not as familiar with fixed income indexes. They're not as widely followed, really, as equity indexes. Um, a lot of fixed income indexes, especially ones that are focused on like emerging markets or high yield, will trade bonds that are from maybe smaller issuers, maybe from random regions in the world, kind of stuff like that. So a lot of these issuers, especially the smaller ones, are going to lack liquidity in their bonds. So it does make it difficult for investors to easily track a fixed income index. Um, much more difficult when compared to an equity index, that's for sure. In comparison to equity indexes, the constituent securities of fixed income indexes are A, more liquid. Nope, just went over that. B, easier to price. Nope. And that kind of goes back to the liquidity piece as well as the fact that fixed income valuations are a little bit more complex and require a bit more math than um, just looking at a stock price on Google Finance. We'll get into the pricing of bonds a little bit later in the next topic, the fixed income topic, but just keep that on hold for now. We're left with C, which is the answer that fixed income indexes or the constituents of fixed income indexes are drawn from a larger investment universe. And this this is true. The fixed income market is around 3 times the size of the equity market. Um, so by a large amount. This is on a global scale. And even if you just kind of think of it, you're getting all this additional debt from governments. Like the U.S. government debt is massive now. I don't even know how many trillions. I think like 19 or something. Whereas the U.S. government obviously doesn't participate in the equity markets, right? Like they're not publicly traded. So fixed income, there's a much larger investment universe, a lot more opportunities out there, but also due to that, you're going to have the difficulties that I crossed out here with some of them being less liquid and difficult to price. Commodity index values are based on A, futures contract prices, B, the market price of a specific commodity, or C, the average market price of a basket of similar commodities. So they're actually based on futures contract prices, which is a little bit weird if you kind of think about it. It is definitely different than equity indexes. But the main reason for this is that the vast majority of people who trade or or are gaining exposure to commodities prices do it in the futures market. And the main reason for this, and once again, we'll dive into it a bit deeper in the derivative section, but if you're trading commodities in the spot market, like you're actually going to have to physically buy oil and like store it somewhere and transport it and all that. I mean, like for commodities such as gold, I guess it's doable depending on how much you buy. Like if you're, dropping a couple thousand, it's not a big deal to hold some gold around, but if you're dropping millions and millions and millions, you're gonna have to store it somewhere. Um, so like your hedge funds and your institutional investors and all that will typically just engage in futures contracts, which don't always require physical delivery, which is a big thing, right? Like if you want to gain exposure to oil prices, but you don't have refineries, then you're gonna have to trade in the futures or forwards markets. But like I said, we'll dive into it a little bit deeper. But this is the main reason why commodity indexes are based on future prices. A unique feature of hedge fund indexes is that they are frequently equal weighted. Nope. Are determined by the constituents of the index. Yeah, this is it. But we'll look at C as well. Reflect the value of private rather than public investments. No, they can um, well, I mean, hedge funds generally trade in public equities, but some of them might have like a private equity arm or fund or division or something. But this one's wrong as well. The reason why B is correct, and we've kind of touched on this a couple times, that hedge fund indexes suffer from survivorship bias, which basically means that like there's an element here within hedge fund indexes um, where hedge funds by law don't have to report their return. They only have to report their return to their investors. So, you know, hedge funds who haven't had good performance that year, let's say the market returned like 25% and the hedge fund returned 10, well, they're probably not going to be boasting about that 10% return when someone could have just put it into an ETF and not pay their fees and done 25% instead, right? So the values of hedge fund indexes are determined by those who actually report their returns. So survivorship bias, um, and it makes return calculations a little bit more difficult to gauge for the entire hedge fund universe. But at the end of the day, like it is what it is. It's kind of just one of those things. And from the returns that are reported, they can kind of be used as a proxy to see how hedge funds did. But there's really no way around it here.